one of the most important things that traders do, which time after time after time results in traders losing money, is they bank their profits too soon and they run their losses. There was a study undertaken by a large brokerage firm, and what they found was their average win rate of their traders was 64%, pretty good, and yet 75% of their traders lost money. If you're risking this amount to only end up banking this amount, then you're going to lose money. And the reason that people bank their profits too soon is the desire to be right.
98% of people out there only focus on the one thing, how to make money. But they don't really actually pay much attention to the second part, how to keep that.
A losing trade isn't actually a bad trade. A lot of people associate losing trades with bad trades. It's just a trade that didn't work out.
All right, guys, hello and welcome. In this particular video, what I want to try my best to do is ask my good friend and trader, Charlie Burton. Charlie is an experienced trader, has been in the business now for almost 20, maybe 24 years. And what I want to ask Charlie Burton is this: what are the key habits? What are the key dangerous, really bad habits that traders have, or maybe investors have, that makes them lose money? And maybe we can all learn from his experience. I'll be interested to know what he has to say. All right, guys, join us.
Hey guys, welcome back. I just want to quickly mention our sponsor for this video, Pepperstone. Pepperstone was voted Best MT4 Broker by the Good Money Guide in 2023 and the TradingView Broker of the Year in 2022. Pepperstone was also awarded in 2023 the Day Trading Broker of the Year by daytrading.com. Now, these awards are great, but as you know, what traders also want from a good broker are tight spreads, fast and reliable execution with great customer service. So what if I told you that Pepperstone offers you all of that? For example, on the euro dollar, their spreads are as low as 0.7 pips. And on my favorite market, the S&P, the spread is only 0.4 points. As for execution speed, the average is 30 milliseconds, which is remarkably fast, but can depend on the market you're trading. If you use TradingView, that's great because you can also connect that to your Pepperstone account and trade through that. By the way, as you already know, trading carries significant risks, so please trade responsibly. If you want to withdraw your money, no problem. Pepperstone allows you to withdraw any funds into your bank by the next day, or back to your card in 3 to 5 working days. Did I also mention that Pepperstone was voted #1 for overall client satisfaction, value for money, charting, and trade execution? To open an account, it's very simple. Go to the link in the description, apply for an account, and check out this award-winning trading platform for yourself. Remember that any money we get from sponsors is given to charity, such as rescuing abandoned animals, like the dog I mentioned in the previous video. Alright guys, let's get back to the video.
Alright guys, welcome back. So Charlie, listen, this is really something which I think we need to talk about because there's so many people out there who have very little experience in trading, and maybe even those that do probably haven't built the sufficient knowledge base. They don't have the same experience that you do. They don't necessarily see the markets maybe the same way you do it, or the same way you and I see it. So I'm really interested to know from you, and maybe you can share with everyone on YouTube and everyone on social media, what are the big trading habits? What are the habits that make people lose money and fail over the long term?
Yeah, I mean, emotional resilience is one, and I'll explain what that encompasses. But from a statistical perspective, one of the most important things that traders do, which time after time after time results in traders losing money, as you've just said, is they bank their profits too soon and they run their losses. And what I mean by that is they either don't use stop losses as traders. Investing is different, but as traders, you should use stop losses. And so they either don't use them or they use them. They have very, very wide stops because they don't want to get stopped out of a trade. And then they bank their profits too soon. So what happens is if you're risking this amount to only end up banking this amount, then you're going to lose money because you might have lots of little winners like that, but you have one loser comes along and it'll take all that. In fact, there was a study undertaken by a large brokerage firm here in the UK just a few years ago, and they looked at their entire retail traders book, and what they found was their average win rate of their traders was 64%, pretty good. So quite a high win rate. So the average win rate of all their trades was 64%, and yet 75% of their traders lost money. Wow. Go figure. The reason that 75% of them still lost money despite a high win rate is that, yes, they'll have lots of little winners, and when the big losers come along, they wipe out all the winners. So banking your profits too soon. And the reason that people bank their profits too soon is the desire to be right. So again, it comes back down to us fundamentally that of course we want to be proven right on a trade, and we do that by banking our profits. So then that emotional side of the game comes in. So what we need to do as traders is to build, as I said earlier on, emotional resilience to the market, and not think I've got to be right on this trade or the next trade or the next trade, and look at yourself and your trading over the next 1,000 trades, and accept that over 1,000 trades there's going to be plenty that are going to be losing trades, but that doesn't matter, because you're just trading the probabilities of saying, right, if I stick to my trading plan and I get in here and my exit is going to be up here, and don't allow yourself to jump out on emotions all of the time, then you're going to put yourself in a much better position.
Yeah, you're absolutely right. I just want to add a couple of things to what you just said. Number one, a good friend of mine, Paul Elliott, once said, there are two things with money. One is to make it. The second is to keep it. Almost everyone, universally, 98% of people out there only focus on the one thing, how to make money. But they don't really actually pay much attention to the second part, how to keep that. Famously, as I'm sure you know, Charlie, is a famous book called Reminiscences of a Stock Market Operator by Jesse Livermore. Jesse Livermore famously made huge amounts of money in the 1929 stock market crash, the Wall Street crash, and then he lost it all. He made a significant amount of money, significant amount of wealth, but the one thing he didn't do was know how to keep that money. He lost everything by the end of the 30s. There was something else you mentioned, Charlie, which I want to add to. You said that one of the reasons that people close their trades and take profits early is because they want to be right. I agree with you, but I think there's another reason behind it, which is that often whenever anybody starts trading, first, they don't put a stop loss in. What usually happens is they don't worry about risk. So they end up losing money. They make a little bit of money and then quickly lose it. And then what goes in their heads is the psychology becomes like this. They say to the market, I won't let you take this profit away from me. The next time they make a little bit of gain, a little bit of profit, because they lost money last time around, the last few times. Now they're bent on, they say to the market, no, you're not going to take this profit away from me. I'm going to take it now. So they close the position. So it's more of a fear of failure, fear of loss as well, which goes into it. That's my view. I don't know what you think about that. But.
Yeah, absolutely. I mean, it's all emotions, and it's funny, as human beings, we always want to try and fix things. That's what we do. We want to. So if we lost last time, right, we've got to fix something. Something must be wrong. And actually, a losing trade isn't actually a bad trade. A lot of people associate losing trades with bad trades. It's just a trade that didn't work out. And so as long as you're following your plan, that's the most important thing. Your trading plan, that's what's most important. So if you follow your processes, then the outcome will take care of itself. It doesn't mean that you're going to be right 100% of the time, but you don't need to. We're just trading the probabilities, really, of putting those odds in our favor and accepting that, some trades are just not going to work out. Don't react to them. Don't try and fix it. Don't allow fear to kick in, as you've just quite rightly pointed out, and then that affects you going forwards. Now, it's easy for us to just say these words here. It's a lot harder in application, and that's why I spend most of my time with traders talking about trader psychology and trader mindset, because it's the most important part of trading and investing, as you quite rightly know.
I agree with you. So we've covered one major bad habit that traders have. Let's go with two more. Let's do three in total. So what's the second one you would say that is a bad habit that traders have?
I think another one, such a common thing, is this desire. I don't know why they do it, but they want to go against the trend. So if a market's going higher, they're looking for the top and trying to short it. And if the market's going lower, they're looking for a bottom and trying to buy it. So I think that's a massive problem. And it's not that you can't, as a very accomplished trader, sell a market that has been going up or buy a market that's been going down. If you've got, again, if it's part of your method, your strategy, and you have an overall plan for that, that's fine. But that's not what the masses do. So the masses, they're just saying, oh, that market's gone up a lot, I can't possibly go any higher, and then they just start shorting it, don't use stop losses, and then it ends up in carnage. And likewise the other way around. And we see these figures constantly. There's free information on the internet, so we can see what traders are doing collectively. And so often when we see a market going higher, they're short. But that's not normally what the professionals are doing. So when the market's going high, the pros, they're all long with the market, and likewise the other way around. So it's a big problem that traders have. And again, it comes from the emotions, that gut feel, trading on emotions, saying, oh, it can't possibly go in higher, rather than actually having a plan and just trading their plan.
There is one thing I want to bring up here, because I'm sure we're going to get this in the comments. Let's say a market is going down in a downtrend, it's moving down and down. A lot of people believe, and I'm sure you know this yourself, people will say, well, hang on a second, Charlie. Surely if a market's going down, like a market you want to get into, isn't it right to dollar cost average, average down, like it goes down 10 points. So just average down. Now, there is a risk that comes with that. And in fact, the trader Paul Tudor Jones mentions this. I think Paul Tudor Jones says in Market Wizards that his famous phrase was losers average losers. I think I'm right about that, or losses average losses. So how do you get around that? Because there's, I guess, instability in this thinking. One says, be careful, don't try to pick a bottom, which is right. I agree with you. That's dangerous to try to pick a bottom. The other one says, no, dollar cost average as it's going down. Surely that's the logical thing to do, and build a position as it's going down, eventually waiting for a bounce or a rally. So how do you get around this dichotomy?
Well, there's two different distinctions here. One, we're talking about traders versus investors. So as a shorter term sort of trader, then you don't want to be, you can't dollar cost average, because very quickly you'll blow up your entire account. Because shorter term traders are usually trading futures, options, CFDs. They're using leverage. So if you're a shorter term trader, then you just can't do that. And that's why Paul Tudor Jones says, losers average losers. If you're a long-term investor and you're trying to put your capital at work for the long term, then dollar cost averaging is one of the best investment techniques you can actually have, just to put a little bit of your investment capital into an asset class, periodically, whether it's monthly or quarterly, if you're saving into something for your pension or whatever, then that as an investment that's not leveraged, and you're looking to hold on to that for a long time. So you've asset allocated naturally anyway, because you're saying, right, well, I'm investing whatever it is, a small amount of capital into an investment class, which could still go down and continue to go down against you, but you're quite happy to say, well, but that's for the long run, and I've allocated a certain amount of capital to that. It's not all of my capital. So I think that's the two distinctions to make there. But as a trader, you don't want to be trying to short markets going up or buying them as they're going down necessarily, unless you've got a technique for that, a specific strategy. And averaging in to losers as a trader is very quickly going to compound your losses if you're using leverage.
I agree with you. I think you're right. One thing I want to add is my own personality. And again, this is just a personal style that I have. I'm not saying it should be the same for everyone. My own personality is that I don't like dollar cost averaging, because it hasn't worked for me in the past. And I find it very dangerous personally for me. Again, my experience is a bit different.
I think so, and I'll add to that. I think, again, if what I'm talking about with dollar cost averaging, and it is the best long term, and I'm talking about investing into your pension. I'm not talking about just being in something for 6 months or so. Then no. But if you're putting money aside into a mutual fund, then you can just dollar cost average and just put money in every month, part of your salary or whatever. Then that is a great investment strategy, so to speak, that you're just putting money into your long-term pension, and you're just averaging into it through whatever the markets are doing.
Absolutely,
But I agree with you. If you were trying to get into something and you just wanted to be in it for 6 months or a year, then again, that could still be could still not work. Traders, I'm talking about here, on the emotional side of things, is that they can't control emotions. So they'll do things like revenge trade or overtrade, which is so common. They trade too much. I think people get into trading and then think they've got to be doing something, because as human beings, we feel that we've got to be doing something all of the time. I've got to be in trades. I've got to be. And actually, as a trader, even if you're a intraday trader, so very short-term time frame, most people, certainly in their first year or two of trading, probably are trading too much. Most people, because of that emotional side of things, and that desire to feel like we're doing something, Whereas what we should be is like a fisherman sitting on the side of a lake, and he's got his fishing line out there and he's just waiting for the catch to come along. He's not just frantically throwing the line back out. Why is a fish not coming? You know. And so he sits back and he's eating his sandwich and he's reading his book or whatever he's doing. And then when the line takes, then he catches his fish. So I think from a trading perspective, over trading and revenge trading are a real problem for a lot of people. So if you have a look at your trading, probably have a look and see, well, okay, what's my trade frequency like? How often am I trading? Am I trading too much? Because a lot of people probably are.
I agree with you totally. And guys, if you haven't already done this, make sure you do it, which is Charlie runs a fantastic service, his membership, his gold level membership. If you haven't already taken up the offer that he made, go on this link. That's charlieburtontrading.com/LT Gold. And then you apply the promo code LT Gold and you get the nice discount. Take it for a test drive. I don't think you'd be disappointed. I think you're going to like it very much. And Charlie, just explain very quickly what's involved.
Yes, some of my members are money managers now, or fund managers. One of them who himself, his best trade last year, he made $233,000 on. So a great trade he had there, just using the techniques that essentially that I've taught him over the years. And I trained him several years ago personally, but he's still a member of my community to this day. And I think that's a really important thing, that these people are, now I have people who have got experience right the way up to 30 odd years worth of trading experience. They don't need me, but it's still nice being part of a community, because trading can be quite a lonely thing. And to have that guide, same with what you have with your members, to have that, just general guidance to help them. And they like being part of a community because it's lonely on your own. People in my community have full-time jobs, so they can't be in the trading room itself all of the time with me. They can cherry pick whenever they want to come in. Everything's recorded. All my sessions are recorded, and that suits a lot of our members. So, but yeah, it's really about serious traders. This is not some get-rich-quick thing, and so it's about people who are serious about their trading and wealth generation over the longer term.
Fantastic. Great. Thanks very much, Charlie. I appreciate that. Guys, I'll put the link for you guys in the description. Check it out. And I'll see you guys in the next video update. Cheers.